What was the one place you could escape Shortland Street and Home and Away? Sky. If you're born in New Zealand or lived here most of your life, you know Sky. It was the only place to get various movies, shows, sports, and cartoons that were much better than the ones on Studio 2 and Sticky TV. Sky was it, the complete package for all adults and kids of the house. It was a monopoly in the market as it was the only provider and nearly every household had it. But now, where everyone's moving into a world of Netflix and chilling, where online streaming is taking over the television industry, driving television stocks to crash, there's one question on everyone's mind. Is SkyTV stock cheap or dead?
So this week we've decided to do SkyTV. Why? Because it was our very first suggested stock. In this video we'll tell you the facts about SkyCity and our final opinion on it. If you have any suggestions on future videos, leave a comment below. But for now, let's get right into it.
Over the last 5 years, Sky share prices dropped 95% from $2.90 to just 15 cents a share, which is not surprising considering they reported a loss of $240 million in 2018 and $607 million in 2019. But just 3 years ago, in 2017, they reported a profit of $167 million. So, if the stock is clearly one left for dead, how did Sky manage to successfully secure $157 million through capital raising from institutional and retail investors? Are these investors making a mistake? Do they not know the trend of the stock? Or is there something that we're all missing that those investors are seeing and jumping on the opportunity to buy the stock while it's dirt cheap? Let's start answering these questions right now. Alright, let's start with their product. From all the channels they offer, it's safe to say that Sky Sports, potentially the kids channel like Nickelodeon, and Sky Movies are their favorites. Also, having on-demand capabilities is a plus. Now, here's the kick in the gut. It will cost you around $80 a month to get that all. If we compare it to any other subscription service in the market, take Netflix. A standard subscription is $12 a month. Disney Plus is $9 a month. So at a fraction of the cost, people can get much more variety, accessibility, flexibility, and reliability. Although Sky stated that they're listening to their customers and reducing prices, competitors are undercutting them by so much to the point where most of Sky's product becomes redundant. Now, they do have Sky Sports. However, they also have competition for it. Spark Sports are stealing huge coverage rights on sports right from underneath their noses. A few examples of this: the 2019 Rugby World Cup, which was streamed by Spark Sports. Another example, after 2 decades of Sky broadcasting cricket, the rights to the Black Cap, White Ferns, or any other domestic cricket games will now be broadcasted by Spark Sports for the next 6 years. This news saw a sudden drop in Sky's stock price of 20%, as their main selling point is Sky Sports. So now, how is Sky, knowing that all these things are an issue, adapting to the situation and the changing market of how we as consumers watch TV? Well, they're doing this by expansion. Sky did not give out a final dividend payment in 2019. Their reasoning? As stated by them, they're focusing on growth, especially in the streaming sector, as they saw a 50% increase in online streaming of their current product, NEON, which is an online streaming platform that hosts popular shows like Breaking Bad on it, leading to a 16% growth in streaming and commercial revenues. Additionally, Sky purchased Lightbox in late 2019, a streaming service like Netflix or NEON, which they will merge with NEON into one streaming platform July 7th, 2020. Not only providing the content, Sky plan on providing the internet to stream these too. Sky has announced that they're moving into the broadband sector, hence why they did a capital raising of $157 million. As stated by them, Sky will focus on hundreds and thousands of New Zealand homes that are fibre ready through ultra-fast broadband scheme, but not yet connected.
If we just go back a few years, Sky's financial performance prior to 2018 was surprisingly decent. They have been making roughly $150 million a year. So what was the reason for the sudden huge losses of $195 million in 2018 and $150 million in 2019? It was due to impairment of goodwill. In 2018 and 19, Sky decided to impair their goodwill of $360 million and $670 million in those years, respectively. Impairment of goodwill is a non-cash loss, so Sky didn't actually lose any physical cash. In fact, in 2019, they would have made profit of around $60 million if you exclude impairment of goodwill. But this number is what is actually concerning. This rapid decline in profits really show how Sky has been shifted down by their competitors. Their main source of revenue, residential satellite, has declined over $100 million in the last 3 years, from $725 million to $629 million, while their other subscription revenues like NEON and FanPass revenue has only gone up $16 million in the same period. Furthermore, in the investor briefing, Sky has announced that they estimate around 20 to 25 million in profit for FY 2020. If Sky continues to decline like this, the company could end up being unprofitable. But investors have poured in 157 million into the company, so there must be a reason, right? If we check out the numbers, the equity raise of 157 million was done at a share price of 12 cents a share, which would result in a total of 1.75 billion shares. This means the investors were essentially buying the company at the price tag of $210 million. For these investors, if Sky can just maintain their current forecasted earnings, they would essentially be making 10% return per year. So the big question mark here is, will Sky's new attempt at entering the broadband market be enough to keep them profitable?
Just before we give our opinions, we just want to make it utterly clear that this is purely our personal opinions and it should not be taken as financial advice. So I'll start with my opinion. For me, Sky is falling apart because of two factors: competition and the behavior change of how we view TV these days. On the positive side, they're expanding and trying to adapt to the current standard of how we view TV, with further expansions into broadband. But with the constant declines in profits in the last few years, will this adaptation and expansion be enough to bring them back to life? I don't think so. Not for the long term anyway. They may see a few boosts when they merge Lightbox and NEON and potentially when broadband is live. But I don't see long term for it. Sky has already fallen so behind in the race for me in terms of brand, content, experience and technology. Their competition is just so many years ahead with loyal customers who will be hesitant to change platforms, as I believe people don't like change. Because of this, I think Sky as a business will have a very rough time in the next 10 years. So for me, Sky is not cheap, it is dead.
In my opinion, Sky maintaining at least $20 million in profit each year with the NEON and broadband service is a very reasonable number. But Sky has already fallen behind its competitors like Netflix and Spark. And with the declining trend in the traditional TV viewings from millennials like me, their current business model is not something I can trust to last a lifetime. So while I do believe Sky is potentially cheap right now, Sky is not a buy for me.
Hope this video was helpful to you and helped you understand the business and its overall outlook on how we see things. If it was helpful, make sure to hit that like button, and if you're new to our channel, hit that subscribe button for weekly videos.
We'll see you next week.